Welcome to The Explainer. Today, we're jumping right into one of the wildest, but also potentially most profitable times in the market, earnings season. We're going to break down a strategy designed to find a real, tangible edge in all that chaos. Unlike some random news headline that comes out of nowhere, we know exactly when a company is going to report its earnings. It's right there on the calendar. So this makes it a really unique event. It's predictable volatility. And that means it's a moment of high risk for sure, but also, if you're prepared, a moment of incredible opportunity. So the big question is, right? If everyone knows it's coming, where's the edge? How do you get an advantage? Well, the secret isn't about trying to be a psychic. It's about having a disciplined system that lets you react to what the market is telling you, not what you hope it's going to do. And that's where this strategy comes in. At its heart, it's a really simple but super powerful two-part system. It's all designed to help you filter out the noise and focus only on the plays that have the highest probability of working out. It's all about separating your prep work from your actual trading. Here's how we're going to break it down. Part 1 is all about the homework. Before the report even comes out, we run a scan to find the strongest possible candidates. Then, Part 2, we just wait. We let the market show its cards after the news. We only pull the trigger on a trade if the price action confirms what we were looking for. All right, let's dig into Phase 1, building that all-important watch list. I want you to think of this as a giant funnel. We're going to pour thousands of stocks in at the top, but only a tiny handful of ideal candidates are going to make it out the bottom because our criteria are so strict. And let me be super clear about this. Our goal here is not to predict anything. We are not in the crystal ball business. The point is to find strong stocks that are already showing positive signs before the news hits. We are building a list of high potential possibilities, not prophecies. So what exactly are we filtering for? Well, there are 4 key checks, 4 simple but absolutely non-negotiable hurdles that every single stock has to pass to even get a look. No exceptions. Let's walk through them. First up, timing. We're only looking at companies reporting in the next week or 2. Keep it focused. Second, liquidity. The stock has to trade a lot of shares every day, so we know we can get in and out without a problem. Third, the trend has to be our friend. The stock must already be in a healthy uptrend. And finally, strength. We want stocks that are already flexing their muscles, trading near recent highs. Okay, watch list is built, we've done our homework. Now for the fun part, execution. We've got our short list of candidates, but we do absolutely nothing until after those earnings are released. Now, we just sit back and wait for a very specific pattern to show up. But hold on, before we get to the trigger, there's one key idea we need to nail down, the opening range. It's a simple concept. It's just the high and the low price that a stock sets in, say, the first 15 or 30 minutes of the day. This little window of time is basically our battlefield. It tells us where the initial fight between buyers and sellers is happening. So let's walk through the classic bullish scenario, the gap up long. Imagine a company on our list just knocked their earnings out of the park. When the market opens, the stock price is way higher than where it closed yesterday. That's called a gap up, and it's the first ingredient we're looking for. But here's the thing, a big gap up is just the start. It gets our attention, but it's not enough to get us into a trade. For this to be a go, it has to meet 3 non-negotiable criteria. We need that gap, we need the price to hold a key level, and we need to see a ton of volume pouring in. So let's get really specific. What do these criteria look like? First, that gap up. We want it to be a real head turner, something like 3 to 5% or more. Then the price has to prove itself. It has to hold above the high of that opening range, which tells us the buyers are in complete control. And finally, you got to see the volume. The number of shares trading should be way higher than normal, confirming that big institutions are jumping in. Okay, let's say we've got the perfect setup. The gap is there, it's holding strong, volume's flooding in, it checks all the boxes. Now what? How do we actually, trade it? A good system has to have crystal clear rules for getting in, getting out if you're wrong, and taking your profits. The mechanics here are actually pretty straightforward, and that's by design. Your entry trigger is the moment the price breaks above the high of that opening range. Simple. Your stop loss, your safety net, goes just below the low of that same range. That defines your risk. As for taking profits, a solid approach is to sell some of your position when you're up by the same amount you risked, and then you can let the rest of it run. So far, we've been all about the good news, right? The big positive surprises. But what happens when a company on our list releases bad news and the stock tanks? Well, the beauty of a good system is that it works both ways. The same logic works perfectly in reverse. And you'll see the logic here is like a perfect mirror image. For a long trade, we're looking for that big gap up that holds above the opening range. For a short trade, we're looking for the opposite, a nasty gap down that tries to rally but fails and then breaks below the opening range low. It's the exact same idea, just flipped on its head. All right, now let's talk about what is, without a doubt, the most important part of any trading strategy, especially when you're playing with the fire of earnings volatility. I'm talking about risk management. These rules are your safety net. This is what separates a systematic approach from just gambling. And these rules are all about staying disciplined. First off, don't go crazy. Limit how many of these high-stakes trades you even attempt in a day or week. Second, know your number. Always cap how much money you're willing to risk on any one trade. And finally, and this is a big one, know when to just sit on your hands. If the opening is just too wild and the range is huge, just walk away. There's always tomorrow. So when you boil it all down, the entire strategy is this simple, repeatable loop. You scan to find the best candidates. You wait for a specific trigger to get you in, and then you manage the trade and your risk meticulously. That's it. Scan, trigger, manage. And that really brings us to the big takeaway here. This whole approach is built on one core belief, that having a solid, repeatable system is way more valuable than trying to make a perfect prediction. It's about reacting with a plan instead of just guessing in the dark. So I'll leave you with this question. In the long run, what do you think wins? A good guess or a good system?